What's up, YouTube? This is the Working Investor. In today's video, I'm going to talk about a big mistake that people are going to make if they don't pay attention and use some wisdom when they are about to make their purchase on their home. A lot of people think that renting a home is a waste of money, you're throwing money into the garbage, and when you have a mortgage, you're building equity. Well, you need to pay attention to the interest. You need to pay attention again to the interest, not just the payment. So a simpleton will think, let's say, for example, somebody has a $400,000 home with an interest rate of 7.25%, only 7.25%, right? It's ridiculous. And they would put 20% down because they want to avoid PMI. So they have an 80% loan to value ratio and they have a loan of $320,000 that they're going to have a mortgage on. So let's just pretend that taxes are 4,500. Of course, that could vary tremendously depending where you live. So let's say the mortgage is 2657 and change, right? So a simple person will think, "Oh, I can afford 2657, right?" I mean, that is a lot of money, but some people say, "Oh, I can afford it, so then I'll go ahead and go with a mortgage." That's what the lender wants you to think. That's the logic that your real estate agents wants you to think. But friends, what I want you to think about is it really worth it? How much are you actually building? Are you building up in equity, right? So those interest rate of 7.25% over the year, you're paying 23 and a half, over 23 and a half thousand dollars in interest. Can you imagine paying over 23 and a half thousand dollars in interest? And then you're paying another $4,500 roughly a year in this scenario in property tax. These these charges do not increase your equity. They don't increase your value at all that you own. They don't have any debt, you know, it doesn't reduce your debt by anything. And let's say you have to pay for home insurance of $1,200, right? Again, that again does not reduce your amount owed. And let's say over the year, if you take 2657 and change times it by 12, multiply by 12, over the year you've paid $31,895.57. Of that amount, maybe you've reduced your loan by $2,673 and change. That's it. That's a tiny sliver. That's barely 1 month of mortgage, which is going towards your principal, 11 months of mortgage going towards everything else. So now, friends, let me ask you again. Let's say you're renting a house for $1,500 a month, right? You're thinking to yourself, yes, I agree that you are throwing $1,500. You're not building any equity. You're spending it on your rent versus 2657 a month on a mortgage. But of that 2657, only 2435 is being used to pay for interest, taxes, insurance. So only you're really paying $935 more a month for the luxury and the benefit of having a mortgage, just so you have the privilege of paying down $100 or $200 a month in equity. Wow, that sounds mind-boggling. It's a fun fact that in Latin, the word mortis means dead, engaged stems from early German vocabulary, which translates into Old French, meaning pledge. So mortgage actually means death pledge. Anyways, in a less somber note, what is the solution? The solution is if one feels like purchasing a home is the right decision, then one should at least plan as if interest rates are not going to go down. So if one cannot afford the mortgage or one can foresee issues with being able to afford the mortgage, then one should reconsider. Number two, try to pay a little extra on your loan. It's good to round up the payment to the nearest hundred or round it up a couple $100 and make sure you apply that towards the principal. Because as you've seen, with every payment, you're only paying down about $100 or $200. So if you were to increase the payment by 1 to 200, you're literally going to double the speed of which you're paying down the loan in the scenario that we presented. And also, how home prices really do matter. Contrary to what your real estate agent will tell you, oh, it's just a couple, it's just 10 grand more, 20 grand more. It's not a big deal. It's just going to make a little, set you back $50 a month, $100 a month. That is a big fallacy because For every dollar you are taking out, you are going to pay back with interest. And when interest rates are really high, then that interest is going to really impact you significantly. Anyways, I hope you guys found this helpful. Let me know what you think. Have a great day.